Building wealth doesn't have to be risky. If you're looking for safe ways to grow your money while ensuring financial security, low-risk investments are the key. In this video, we'll explore the best low-risk investment options that provide consistent returns without the stress of high volatility. Whether you're starting with savings or looking to diversify your portfolio, these strategies will help you generate steady income over time. Why choose low-risk investments? Many people believe that investing always involves significant risk, but that's not true. Low-risk investments offer stability, making them ideal for conservative investors, retirees, or anyone seeking predictable returns. These options prioritize capital preservation while still allowing for gradual financial growth. Key benefits of low-risk investments include protection against market fluctuations, consistent and predictable income, reduced financial stress and uncertainty. Now let's dive into the best low-risk investment options. 1. High-yield savings accounts. High-yield savings accounts are an excellent option for those looking to earn interest on their savings without taking on risk. These accounts offer higher interest rates compared to traditional savings accounts, allowing your money to grow while remaining fully accessible. Benefits: FDIC or NCUA insured, ensuring your money is safe. Easy access to funds for emergencies. No risk of losing principal considerations. Interest rates may fluctuate. Lower returns compared to other investment options. 2. Certificates of deposit CDs are time-based deposits that offer fixed interest rates over a specific period. They are ideal for those who can lock their money away for a set term in exchange for guaranteed returns. Benefits: fixed predictable interest rates. Insured up to $250,000 per account. No risk of market loss. Considerations: limited access to funds until maturity. Penalties for early withdrawal. 3. Treasury bonds and bills issued by the U.S. government. Treasury bonds and bills are among the safest investments available. They offer steady interest payments and the full backing of the federal government. Benefits: virtually risk-free. Reliable income through interest payments. Available in various term lengths. Considerations: lower yields compared to corporate bonds. Interest rate risk if sold before maturity. 4. Dividend-paying stocks. For those willing to take on a bit more risk while still maintaining stability, dividend stocks are a strong choice. These are shares of well-established companies that pay regular dividends to shareholders. Benefits: passive income from dividend payments. Potential for capital appreciation. Can outperform bonds over time. Considerations: stock prices can fluctuate. Requires research to select reliable companies. 5. Real estate investment trusts. EITE. REITs allow investors to earn passive income from real estate without owning physical property. These trusts invest in commercial, residential, or industrial properties and distribute profits to shareholders. Benefits: regular income from property rents. Diversification without direct ownership. Potential for long-term growth. Considerations: market fluctuations can impact value. Some rates may have high fees. 6. Corporate and municipal bonds. Corporate bonds are loans to companies, while municipal bonds are issued by local governments. Both offer stable returns with varying levels of risk depending on the issuer's creditworthiness. Benefits: higher returns than treasury bonds. Steady income from interest payments. Municipal bonds may offer tax advantages. Considerations: credit risk depending on the issuer. Market price fluctuations. 7. Robo-advisors for conservative portfolios. Robo-advisors use automated algorithms to manage diversified portfolios tailored to your risk tolerance. Conservative portfolios focus on low-risk investments, making them a great option for hands-off investors. Benefits: diversification with minimal effort, low fees compared to traditional advisors, automatic portfolio rebalancing. Considerations: limited control over investment choices. Returns depend on market conditions. Tips for building a low-risk investment portfolio. 1. Diversify your investments. Spread funds across different asset types to reduce risk. 2. Assess your financial goals. Choose investments based on your time horizon and income needs. 3. Monitor your portfolio. Regularly review your investments to ensure they align with your objectives. 4. Reinvest earnings. Compound growth by reinvesting dividends and interest payments. 5. Stay informed. Keep up with market trends and economic conditions to make well-informed decisions. Investing doesn't have to be stressful or risky. By focusing on low-risk options, you can grow your wealth steadily while maintaining financial security. Whether you start with high-yield savings, CDs, bonds, or dividend stocks, the key is to choose investments that align with your risk tolerance and financial goals. If you found this guide helpful, be sure to like, subscribe, and share this video with others looking to build steady income through smart investing. Let us know in the comments which low-risk investment strategy you prefer, or if you have any questions. Disclaimer: investing involves risks, including potential loss of principal. Always conduct your research or consult with a financial advisor before making investment decisions.